We're very proud to be here and very proud to be a co-host of this event. Now, it's time to get our program started again, and I want to introduce some very, very special individuals to you guys. And they're going to talk about something that I know all of you guys really, really like. It's called money. Raise your hand if you like money. Raise your hand if you don't like money. Raise your hand if you're just not going to raise your hand the whole time. All right, first off, up to the stage, we're going to get up here Mr. Graylin Houston. Big round of applause. He's with 360 Tax Group. He's going to be telling us about the tax credits and the current tax situation and how it may impact your client's tax filings. I'm sure we all need to figure out how that's going to work here coming up shortly. Next up, Kristen Babig, Senior Loan Officer for Envoy Mortgage. Kristen is also involved in our industry, serves on the board of VAREP. That's the Veterans Association of Real Estate Professionals. She knows about many different resources available, and I can attest to that. Kristen really knows her stuff when it comes to mortgages. And last but not least, one of my favorite people of all time, one of my mentors, one of the people that has really, really helped get NAREP on the map here in Houston, one of our founding members, actually our founding president, Ms. Olga Garza, Program Director for Harris Housing Advisors. Olga has a lifetime career as a mortgage lender. She's served in the industry in many different capacities, including NAREP. She's a current president of HMLO, that's the Hispanic Mortgage Lenders Association. She's going to tell us all about how we can get our clients money as well. Go ahead and take it away, Miss Olga.
I don't need a microphone, but hello? Do I? Okay, here we go. Thank you, Alan. He's also my best buddy. I tell you what, I sure enjoy working with you so much, Alan. So anyway, first of all, thank you so much for allowing me to be here today. Gosh, it's just a pleasure to always work with you realtors because of the fact that what you do it touches my heart every day that you use our program. So my brief overview is the Harris County Mortgage Credit Certificate. So I've got some stuff I got to tell you. And then we have also what personal experiences I've had doing the MCC program, which I love. And then, of course, some advantages for your first-time home buyers that not taking advantage of the program really makes a big difference. But before I begin, I get to do a disclosure, or better yet, a disclaimer. At the present time, there is the tax reform bill that we all know is going on right now before the Senate. We know that, right? And they all get along really well. And they want to exclude the low-income housing bonds, which exclude the MCC nationwide, the MCC programs nationwide. So our heart's broken because we hope that it won't happen, number one. Number two, Harris County and the MCC program that I've been doing over 20 years has helped so many borrowers. So to bring you up to date, the Harris County MCC, the Harris County Housing Finance Corporation says we're just going to keep on going. And so we did, and they approved, the board has approved the 2018 MCC program for 2018. We're ready to go no matter what, as soon as they say we're okay. So we're up and ready, and we're ready to make it happen. I am going to talk, a lot of you already know about the Mortgage Credit Certificate, and maybe some of you don't know. But the Mortgage Credit Certificate is a program designed for people that have not lived in a home that's their own for the previous 3 years, which usually is your first-time home buyer, right? They're the ones that could probably be the ones using this program. That's number one. These are the guidelines. Now, the buyer must meet income guidelines and purchase price and restrictions. So for a family of one or two, the income would have to be $71,500. Or for a family of three or better, that's $82,225. That's pretty good income. You have a new recent college graduate that's making about $60,000. He can use this program. What a way to help him get started in his first home. So we look forward to helping him with it. Buyers must intend to use the home as their primary residence. They can't be an investor. So we know that. And then the property must be located in the unincorporated areas of Harris County. So what we have are some brochures out front that tell you all about the income guidelines and the purchase price of $304,000 and all these wonderful things that will help you get that borrower through the MCC program. The MCC program is a companion to a loan, so you don't have, it's not a separate loan. It's a companion to an FHA, a conventional loan, USDA, or VA. It's any one of those home loans, and it's a companion to that. At the present time, the Harris County Mortgage Credit Certificate Program is at 50% of the interest they paid for that year, or up to the $2,000, whichever is less, and then for the life of the loan. So every year that the interest that they pay, they can get up to 50% of that interest, or $2,000. That's a pretty good sizable income. That's adding income to their income to help them make those payments. It's so helpful. And then, of course, you know that you want to make sure that it's their primary residence again. So there is a cost for the program. It is 1% of the loan amount plus $75. However, best news ever, we got $1,500 down payment money to go with that. So that's helpful. That's helpful for that first-time home buyer. That'll make it easier for him to be able to get that mortgage credit certificate and get that $2,000 every year. The other thing that's really, really neat, and Kristen, you're going to hear from her, and she's going to tell you where you can stack that 5-star program. And I see some realtors out there that I know love that program, and they use it quite frequently. It's stacking is a real part of their game. I see you, Ruby, my queenie. She does that all the time, where she stacks that Seth MCC along with that 5-star. That borrower gets down payment money, gets into a home, and very, very busy opportunity for each one of the realtors that utilizes the program. So you can stack the programs. Other programs that can happen today. You know, one of the things that Jim said earlier, just unbelievable. He just said, when you give something and you do something. I have been doing the MCCs for over 20 years. I believe in them so strongly because when you give, I don't feel like I do a job. I feel like I'm giving money. Like Alan said, you know, I'm giving money to help borrowers, you know, keep on going. And also the other thing that's real important for you to try to remember is that, and I know you realtors just love to call those first-time home buyers again and again and again and say, hi, how are you? This is one of those really good reasons you want to call them when you give them the mortgage credit certificate program, because you'll have to call them and say, gosh, you know what, Mr. Smith, don't forget, you've got $2,000 in income tax that you can be able to declare as tax credit. So how can I help you get there? And call them back. So it's just another way of touching that home buyer where you're doing something wonderful for them. And it really, really helps. I promise you, they will come and see you over and over again, because this program really helps people get into homes. I wish you lots of luck, and I hope you utilize the program. And let's all say a prayer tonight that they'll pass the bill, that it's not going to delete our MCCs away. Thank you so much.
Thank you, Olga. Can everybody hear me? So I know we all just had lunch, but to bring your blood back in and your sugar back in, who in here knows what the new conforming loan limit is going to be? 453, so everybody take note. So it is going from the 424-100 up to 453, which is great for buyers because it pulls them back down out of that jumbo market for conventional. Couple of things to go over. Yes, money, 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 and finances. First and foremost, 203H. Has anybody in here? Obviously, everybody's here heard of the 203H. A lot of home buyers right now are looking to use this program because it is 100% financing. And I just want you to know that there are individuals out there that are not eligible for this, but that does not mean that they're not eligible for other 100% financing options. There are several other programs out there that mirror the 203H, so please don't be discouraged if you do have a buyer who is looking for a new home that they don't qualify for the 203H. So a couple little, some background about it. From the time that the president does declare the disaster, that person can only have isolated credit, derogatory credit within that time period after. So if you have come across somebody who is purchasing a new home and they are going to look to purchase to use that program, if they have any derogatory credit before that, auto loans, mortgage lates, student loan lates, credit card, they're not going to qualify on that program. It is an isolated derogatory program only, so then you're going to have to look at some other programs, okay? Another thing, if somebody is moving out of state and they want to leave Texas because unfortunately they're not okay with the flood or they've been flooded many times, this loan can be used in other states. So you can, if you do have somebody, if you need to refer them to another state too, okay? One of the big misconceptions with the 203H is that if I have a home and it's flooded, that I can go out and find a new home and do 100% financing, and that is 100% incorrect. Straight from FHA all the way up the ladder with Hawk, that home has to be, FEMA has to state that that home is not going to be rebuilt. Same with apartment complexes. A lot of individuals in apartments right now, the first floor is being flooded and not the second or the third or the fourth, so they're letting individuals out of the leases on the first floor. They want the entire building to be condemned. It's not just first floor. So in that case, just remember that there are other solutions out there and other 100% financing options for individuals if they don't qualify for that 203H, okay? Couple other examples, you've got TDHCA, TSHAC, Seth. There's another program available to individuals that's called the Shinoa Fund. If for any reason you have a borrower who doesn't have money saved for a down payment or doesn't have all of it, the Shinoa Fund is great for borrowers who make over $114,000, and that is 100% financing. It's a first lien of 96.5% and a repayable second lien at 3.5%. If they pay it over 10 years, it's at 0% interest. Over 30 years, it's at 5%. So there are several different, like I'm saying, there's several different solutions out there for if any reason, if you come across somebody that doesn't qualify for the 203H, there's other items that they can do, okay? And as Olga had explained, we can couple all of those with an MCC, so I'm sure a lot of you work with really great loan officers and you've got really great referral partners. Definitely talk about some of those programs because they can help you with those programs and help you co-brand that with your clients so you can get out there and reach the community more, okay? Renovation loans. You do have those available. I know we've touched on those a little bit today. Okay, you do have the FHA 203K, the standard and the streamline. One is going to be financing above $35,000. One is going to be financing below $35,000. You have the conventional home style loan as well, which isn't a rehab loan because oftentimes the FHA loan might not be the best for that particular homeowner. Please keep in mind, and I know everybody here in the room, a lot of the calls that I'm receiving from individuals right now looking for a rehab loan, they're trying to finance in too much. And when I say this, it's if you bought a home for $200,000 and you're only 2 years into it and your repairs are $40,000, $50,000, the likelihood of you being able to roll in all of those costs on a renovation loan is very slim because the highest a renovation loan can go on FHA is 96.5%, which means that that home would have to appraise for the after value, okay? So an SBA will help talk about it because in that case, there's certain times it might be better to do an SBA loan. They don't necessarily have all the insurance money and things along those lines, okay? Some other things that you can kind of take a look at as you see out there with self-employed borrowers. I know Stated was a long time ago. Ed knows. We know all about it. There are other programs available if somebody doesn't qualify for traditional financing. You have bank statement loans, personal and 24-month. So if somebody receives a lot of deposits and they don't qualify because they don't have qualifying income, or if they're 1099, you can take bank statements and do an average to create an income. 12 months, 24 months, and you can do it on a business as well, 12 months, 24 months. So a little tidbit, if you do 24 months, whether it's personal or business, the rate is better. So just keep that in the back of your mind if you run across somebody who's self-employed or who's a contract employee where they do have assets and they can put down a down payment, there's other programs that are available to them, okay? The last thing that I wanted to talk about a little bit is if you do have individuals and you're going to run into them, you know, they're going to be talking about whether or not they are going to rebuild, buy lots, build new homes. There are construction loans available for individuals as well. So that's definitely something to keep in mind because you're going to get individuals that will want to walk away from their home and sell it to an investor, and they do want to start over. And there are loans available for individuals to do that, whether they're just going to buy a lot and build later. They can hold for 24 months. They can do a construction loan one time or a construction loan 2 times. So you definitely have a lot of different options. If you guys have any questions about different programs or have any scenarios, I'm going to be available for questions, but I don't want you to lose hope. by any means, because no, you don't have to have a 20% down payment to get a home. There's tons of loan programs available, and if there is somebody that cannot work right now, it's important as you as realtors, and then also everybody up here on this panel, is make sure you keep them in your pipeline. That's your, that's your bread and butter and your gold, because everything you do now is going to reflect you 90 days later. So everything we're working on now is going to reflect us coming up here in this new year. So it's important to keep them in our pipeline, stay in touch with them if they need to be put on a credit plan so they can be recycled back and help build for the next year.
Good afternoon. How's everybody doing? Good. My name is Graylin Houston. I am the managing partner of 360 Tax Group. I know all of you looked on your paper and said, taxes, oh great, that's going to be the most interesting thing that they talk about tonight. You know, we get the false impression that we're all nerds. We're not all nerds. I swear, we're not. So what I want to talk to you about is what's unique about the Houston market this year with the flooding that we had and the storm that we had. When it comes to taxation, the challenge that most people have is that they either continue to go to the same person that's always done their taxes without having a good way to vet whether or not they're talented or not, or they do them on their own. If anyone is doing their tax on their own and they experience flooding this year, I can tell you this is not the year to do it, okay? 7% of the Houston market experienced what we call in taxation a casualty loss, okay? If you look on your form here, I know it's going to be super exciting when you read it because I stayed up all night to do it. So a casualty loss is a sudden loss in value of an asset. This means that when you have, and it's marked by things like flooding, windstorm, fire, things like that, even theft counts. So typically we don't count casualties on our taxes because there are some advanced rules for when we can and cannot put it on. This market is different this year, okay? The reason why it's different is because if you experience damage to your home or your vehicles for that matter, and you experience that casualty loss, this is going to be extraordinarily powerful for you, and for many people will either generate multiple years of tax refunds in the past, or it can make it so that you do not owe taxes in some cases for several years into the future. Okay? Bear with me, it's a lot to explain. So, when we're going to buy a house, we all have our appraisal done. In the tax world, this is called basis, right? Basis is basically the value of an asset at the time in which you acquire it. So if I purchase a house and the house is worth $300,000 per appraisal, my basis is $300,000, even if I don't pay that much for it. Now, with the storm, what happens with that is, well, as we go into our itemized deductions, we're looking for your basis the day before the storm and the day immediately following the storm. The reason why this is important for you to understand is because I may have a home that's worth $300,000 the day before Harvey, and then I experience flooding damage the day immediately after. My repairs on that house could be $50,000, but I could have lost $150,000 in value. Does that make sense? So what that means is that I come in and I say, well, I've lost $150,000 worth of value in my property the day immediately following the storm. And if we all know that there are plenty of people right now who are walking away from their homes or struggling with their homes because their insurance either won't pay or they have a gigantic, in some cases catastrophic, named storm coverage on their property as well. Or they're simply getting insurance checks that are a shortfall of what they actually need to do, right? So when we take your basis of that, the day immediately following the storm, and this is important for all you realtors because this is your opportunity to get referral partners that you wouldn't normally get, being tax professionals. Because we have to value that storm immediately after, that has property immediately the day after the storm. No appraiser was available, am I right? We couldn't get people to come in there and board up windows, right? Or put tarps on roofs because everyone was so busy. So we're going to be looking for our realtor partners to come in and help us establish value the day immediately following the storm, because the IRS requires it from me. As a tax preparer, I'm required to show how do I come up with this value. Make sense? So now, we have a person who experienced a $150,000 loss on their home, but they only made $50,000 all year. We now have a $100,000 shortfall, correct? We've got $100,000 left over. Well, what happens to that money? Well, the beautiful thing about that money is it creates what we call a net operating loss. This means we can move that money backwards and forwards. What does that mean? That means that in 2017, I experienced a $100,000 loss. I can go back and apply that $100,000 loss. Actually, if I don't state where I want to put it, it goes back 3 years, then comes back to the second year, then comes back to the first year. This means it may wipe out my income for 3 years ago, 2 years ago, and 1 year ago, and then I will get a refund for those years. Does that make sense? I knew that was going to catch you, right? Everyone's like, who cares?
Everybody's like, where's the money?
Who cares? Wait,
Where's
money?
the money?
Free money in the mail? But here's the beautiful thing about it. What if I can't move it backwards? What if I didn't make enough money? What if I move it backwards and I still have $30,000, $40,000, $100,000 worth of loss that's left over? That net operating loss can move forward 20 years. 20 years. And I can elect what year it applies. So there are people right now that may have made, they're regular hardworking people that are making $45,000 and their house lost $200,000 in value. Remember, because if we think about it, if I told anyone in this room, hey, the storm was yesterday, go sell this house. How much are you selling a house? And someone mentioned earlier Riverstone in Siena, right? How much are you selling that $400,000 house for in Siena when there's 5 feet of water inside of it? Just about nothing, right? So now that person triggers a loss of possibly $300,000 to $400,000 in that year. And now they can move that and place that different places. This is what's really going to get you. What happened tax day last year? I know what happened. I finally got some sleep. But what happened tax day last year? We had another catastrophic flood. What happened on Memorial Day 2 years ago? We had another flood. They can go back and amend their taxes, because I can guarantee you their tax professional forgot it, did not do it. I have to force people to have conversation with me when it comes to their taxes, right? They're either like, oh, I'm getting $10,000, I'm out of here. Or they're like, I'm going to have to pay, so I don't really want to be around to get that news, right? So they can go back now, amend those previous years, and generate an even larger bucket, because I lose $100,000, I repair the house. Then tax day happens. I lose $100,000, I repair the house. Then Harvey happens, I lose $100,000, I repair the house. Each time it happens, it triggers another taxable event. Does that make sense? Why is this important to you guys, besides all you going, did I have damage in my house? Right? Right? By the way, the same thing happens with your vehicles and any other asset you have, but it's a little bit trickier because the values aren't there that much. Why this is important for you all is because not only do I have a tax company, but we also do real estate training, right? And we do mortgage training. So one of the biggest problems that we have is realtors, we sell the house, our client lives there for 5, 6 years, and we trigger an automated response that says happy birthday, Merry Christmas, or Happy Holidays, and that's almost it. We don't always have a constant touch point to reach back out to people. This is that touch point you have been looking for, because it does a couple of things that your homeowner is already thinking about. I'm abandoning this house, right? If they abandon the house, what happens to the house? It's back on the market, right? If they don't abandon the house and they stay there, I can guarantee you if they had flooding, Their neighbors had flooding, if their neighborhood had flooding, they're in their house right now going, I didn't have it, but did I dodge a bullet this time? I live in Siena. I didn't have flooding. I evacuated during the storm because a neighbor came and said, Grayla, it's time to go. Okay, back up, let's get out of here, right? And I was right by the steep bank levee, right? We didn't crest at all. But everyone in my community is like, it's time to go. I may need to sell this home, right? So this is an opportunity for you to reach back out to people and say, hey, did you know this? They will love you for it. I promise you they will. Not only will they love you for it, but they will also have a reason for you now to reach out, because if they don't know someone, if they didn't flood, they know someone that did. And that person that's having that conversation in their household is looking and going, wait a minute, you're telling me I can do so-and-so thing? This is the money that they may need to cover that shortfall in insurance. This is also the money they need that if they're, I lived in South Florida for 9 years. I experienced Katrina, Wilma. There was 3 of them the first year I moved it from Chicago. All of a sudden I got the hurricanes, right? And so I experienced that market downfall of everyone going, this house ain't worth it, right? I was in the mortgage business even back then when everyone was looking and going, my house, I bought a house for $195,000. At the low point of market, it was worth $40,000, right? I watched people just go, I'm out of here, and steal the kitchen. They literally were taking the kitchen out, not the cabinets, not the appliances. I had one that had no floors. Like, it was crazy, right? So I've watched these people that sit back and abandon, and what they feel is they feel hopeless. This is your chance to come in and be a hero. This is your chance to come into them and say, not only can I put more money in your bank, by the way, if they go back in years and amend, the IRS, because it's a name storm for Harvey, has promised to process these within 3 weeks. A normal amendment takes 16 to 20 weeks. The IRS I can't get them on the phone because they're trying to process these things. They're already ramping up and trying to staff up and approaching Congress for more money for this. So this is an extraordinarily powerful tool for you to have, right? Please don't just look and go, it was taxes, right? It's not the most exciting thing. I'm excited about this thing, right? So that's all I have. Thank you so much. I guess, is the moderator coming up? Okay.
Oh, okay.
See the lady here. Yes, ma'am.
So if they're going to take a loss on the property, but they're still occupying it, right? They haven't sold it?
No, it doesn't matter whether they sell the property or not. Remember, we're getting value the day immediately following the storm. So they do not have to stay in the house in order for this to apply. Now, they do need to deduct any money the insurance company gives them, right? So if they have $150,000 worth of loss and their insurance company gives them $100,000, they apply that, but they still now have the $50,000.
Right, and then when they go to sell years down the road,
Doesn't matter.
and they end up with a profit,
Doesn't matter.
irrelevant.
Completely different form. This information goes on their itemized deductions. That would go onto their income section of that. So at that point, they're doing something completely different. I don't care if they keep the house, sell the house, never live in the house again. It also applies for investors, but it applies in a different form than it does for individuals that live in the house.
Apply to only LLCs or
A casualty loss applies to every single taxpayer.
Okay.
Whether they are a small business, an LLC, a S Corp, a C Corp, sole proprietorship,
Right.
or an individual,
Right.
or a partnership, which
So
we don't like to do.
just to be clear, I want to make sure I'm following the bouncing ball correctly. So if, because a lot of us here are
Yes.
agents, brokers, investors.
Right.
So many of us are a corporation S chapter. So it's going to flow through from our 1120 to our 1040, correct?
Correct.
And so at the end of the day, we are taking it, depending on how the house is actually deeded, whether it's in our name or our corporate name, that's the return it's going to show on. Am I following you correctly?
That's good. Well, we don't care about deed.
Well, you don't?
No, deed is local.
Okay,
So remember, your income taxes are federal.
correct.
So on a federal level, they don't care who has it. I've never in my 18 years of doing this, had the IRS come back and ask for a
Interesting.
deed.
Okay, great, super. And then I had one more thought, and that was for our investors, once they buy the property, and they're in the rehab zone, but they're buying it from the destruction. I know when we've bought distressed properties prior to the flooding, there were only certain items that were actually tax deductible. Doors were not, exterior doors were not, a roof was, things like that. Is there any way you can get us a list, excuse me, that would help our investors when they're doing these rehabs to make sure they're keeping ticket items going forward for their taxes?
Yes. Now, to that point, when you are an investor and you're purchasing a property and you're improving that property, everything is tax deductible. The only time you cannot write things off, what you're referring to, is when a homeowner purchases that property and decides to improve it. But from a corporate standpoint, anything that this is important for all you realtors to understand, because I specialize in doing realtor and real estate agent taxes. You guys miss a lot, because when you go on there as a business, any money that you spend to grow your business is tax deductible. When you're a W-2 employee, you make money, you pay taxes, and then you spend the rest. When you are a business, and it doesn't matter if you have your LLCs and all that is regulated on a state level. On a federal level, we don't care about that. So when you are a business, whether you're a sole proprietor or an LLC or a C Corp, S Corp partnership, when you make money, you spend money, and then you pay taxes on what's left. So if I buy a home in a rehab area or period, and I go and I put money into getting that place up, that is tax deductible for me.
And it doesn't even matter how it's deeded.
No.
It's irrelevant, is what you're telling me.
Your deed is regulated on your county and your state level, not on your federal
Not
level.
on my federal level.
Correct.
And is there anywhere in print that we can read this and disperse this information to some of our investors?
I can certainly get it to you.
I'd appreciate it. I'll give you a
They will fall asleep
card.
when they read it.
I know they will, but that's okay because now we have
It will be an IRS document, and you'll be like, what is this?
we have the viewfinder now.
I can make something for you, which will be better for you. Yeah. Yeah.
Any more questions?
Here. How do you mean?
Who establishes the base value?
So basis is going to be done by your accountant, by the accountant that works on, accountant or tax preparer, okay? So we will go in and we come up with basis, okay? So for investors, it's easier because that property should be on their taxes already. So when we come in, when I say that we'll need you, I don't need you to necessarily establish basis. I need you to help me establish basis.
Okay.
So I come in and I say, well, what was this house worth before that? Because for many of the people, it won't have appeared on their taxes before. So we have to say, what was this house worth the day immediately before the flooding and immediately after? So someone could have bought the house, as we all know, could have bought the house for $100,000 and now it's worth $200,000. The $200,000 would be the basis for taking this deduction, not the original purchase price.
And that $200,000 does not have to be accounted for. We don't have to advise our clients to go and get a property appraised.
No, so I have a call into the IRS right now because they don't know yet.
Okay.
So, because typically what happens is they want an appraisal. Appraisals are impossible. Not only were they impossible immediately after the storm, but we can't go back now to that appraiser and say, it's now November, go back and tell me what this place is worth in August. They don't have a mechanism for it.
Okay.
Right? As you heard the appraiser earlier going, we're still trying to figure this stuff out, right? You still have to work on comps. So we are essentially establishing that basis.
Okay.
That's why it's important that you find someone that you have this conversation with before they start working on your client or your personal taxes, because they have to understand how to establish basis. I can promise you, if you're walking into, I'm not going to say names, but some of the places with the dancing people in front, right? Or, you know, just come some of the back. They're not going to understand basis. Houston is a very unique market in that I never see depreciation on tax forms here. And it's missed. It should be on everybody that has a business, but it's routinely not put on there because it's a little bit more complicated. The quicker we can get you out of there, the more money we make.
Thank you.
You're welcome.
What's the tax code, just so everybody knows, to tell their CPA or tax preparer?
So it's section 165,
Okay, there you go.
but the easier way, instead of remembering the numbers, is to say, how do I write off a casualty loss? All right, how do I write this casualty loss off? Okay. Thank you.